If you're an out-of-state investor interested in buying an oceanfront condo, then you better know how to evaluate an HOA budget. We're going to talk through operating expense ratio, budget variance. We're going to talk through emergency funds, reserve funds, how much should be in the reserve fund, the things that you need to know when evaluating an HOA budget before you buy an oceanfront condo. Now we're going to hop on a live Zoom conference call. I'm going to share my screen with you, and we're going to look at an actual 2023 budget right here for the Beach Cove Resort. I'm going to do this so that you're an equipped investor and that you make a savvy investment decision. Let's get into the video, guys. All right, guys, let's jump into the Beach Cove Resort budget. All right, I know this is super exciting stuff. Let's get it knocked out. So, budget history. Reviewing the historical budget data allows investors to identify trends, patterns, and areas for improvement in budgeting and financial management practices. This insight is valuable for making informed decisions and optimizing investment strategies. Guys, what you want to do is reach out to your broker and have them get a few years worth of HOA budgets. Maybe a year or two, maybe 2 or 3 years, if at all possible. And then you can look for any kind of problems in tandem with the meeting minutes of how they resolved problems, how they worked through issues, how they approached problems, how they decided to finance or how they decided to allocate funds towards fixing problems. And you can kind of look at those trends over the course of two or 3 years and get a good idea of the mindset that's running the board there at the particular resort. It's always good to look back through the historical data. Now, moving right along, delinquency rate. The delinquency rate, which measures the percentage of homeowners behind on their HOA fees, is a vital indicator of cash flow and collections effectiveness. Out-of-state investors should pay attention to this metric to assess the financial stability of the community. Now, in this particular HOA budget, the delinquency rate is not mentioned. You can obviously have your broker reach out and get this information from the property management company. All that said, you can basically do a projection. You can go, well, if the delinquency rate is 85%, and you can kind of take an average of the monthly dues, for 1 bedrooms, 2 bedrooms, and 3 bedrooms, those average HOA monthly dues. And if you know how many units are in the resort, you can, kind of guesstimate. It's not going to be right, but you can kind of guess. Okay, well, there's 350 units here. On average, the HOA monthly dues are XYZ. They should be bringing in about, let's just hypothetically say $700,000 next year. And you look on the current budget, and they're projected to only bring in $500,000. Well, that's a huge difference. Well, what's going on? Well, it looks like their cash flow is not coming in as well, and they're having to reach out to collections companies to help them get the cash, their monthly dues from the other owners at that resort. So that could be a red flag for you going, hey, I don't know if I really want to be at a place that's got 20% or 30% issues on collections as far as getting those monthly HOA dues, because obviously that's going to impact the resort's ability or the HOA's ability to take care of and maintain that resort well. So you don't really know if you really want to be an owner at a resort where they're having a hard time getting their monthly HOA dues paid. Because again, that could set you back, bringing the value that your guest experience down, slowing down the rate at which you guys are getting your repairs done, and likewise. Now, moving forward, let's jump into revenues. Operating expense ratio. One of the first metrics to assess is the operating expenses ratio. Now, this is going to compare the total operating expenses to the revenue generated by the HOA. Now, for out-of-state investors, a lower ratio is preferable as it indicates efficient cost management and financial health within the community. A lower operating expense ratio indicates better operational efficiency because it means that the company is spending less on operating expenses relative to its revenue. Conversely, a higher operating expense ratio suggests higher operating expenses compared to revenue, which may indicate inefficiencies in the company's operations. Now, In summary, while there isn't a universally applicable operating expense ratio percentage for oceanfront condo resorts, a range of 60 to 80% is commonly seen in the hospitality industry. Now, it's important to note here that, an acceptable operating expense ratio for a specific resort depends on various factors unique to that particular property. And its market environment. So, we're not going to be able to nail down an exact number for you, but we can look and see at the gauge of going, hey, between 60 and 80% is what's standard for hospitality. So let's kind of use that as a marker to see how well this resort is doing. Now, in order to come up with this metric, you're going to divide the total operating expenses after subtracting any non-operating expenses by the gross revenue. Then you're going to multiply by 100 to express the ratio as a percentage. So if you look here, guys, if you scroll down to the expenses, see this is the category here on my screen that shows expenses. All of these are the expense line items. We're going to get to the total expenses right here. And boom, we've got $7,033,858. We're going to subtract those non-operating expenses. Right here are the reserves. Now this is, in my opinion, this is a non-operating expense. So we're going to take that 307,000, excuse me, why did we put 308? We're going to take that $307,789 out. And essentially that's going to reduce our total expenses to $6,726,069. We're going to take the total expenses now, which is right here, and we're going to divide that by the total revenues. Now, we got the revenue numbers out of the budget. From the very top here, you see it says revenues, and then it gives us our line budget here. There's our total revenues. Boom, $7,022,130. When we divide that number, it's going to give us like 0.957. Well, I went ahead and multiplied that by 100 to carry us to, or to round up to that 96%. So essentially, we're not between that 60 and that 80% mark for hospitality. We are well above that at 96%. Essentially, what this ratio is letting us know is that the expenses are almost as much as the revenues that are currently being brought in. There's only a 4% cushion there when it comes to expenses versus revenues. They are essentially spending almost every dollar that they bring in on their current expenses. Now, in my opinion, a 96% OER may indicate inefficiencies in the company's operations. I think that's pretty clear to see. Now, let's move right along. Late fees and fines. When I see this in a line item budget, I'm going, well, why are they paying their bills late? Keep in mind, this money comes out of your monthly HOA dues, most likely. So, guys, $13,500 a year, or at least for this last year, 2023, went to paying bills late. I'd want to know why they're spending that much money, in late bills. That would be a question I would want to have answered. Now, expenses, emergency fund. Essentially, you should have an emergency fund. The HOA should have an emergency fund. Having an emergency fund in place is crucial for handling unexpected expenses or emergencies such as natural disasters. And as you well know, this is an oceanfront condo, so we are impacted by hurricanes. Out-of-state investors should ensure that the HOA has set aside funds for such scenarios to protect their investments. This HOA does not have an emergency fund. Now, it could be that the reserves are in the emergency fund, that the emergency fund are in the reserves. I don't know. It's not a line item here on the budget. That's going to raise a red flag for me. I would want to see an HOA that has an emergency fund in place. You can see here that Hurricane Ian is a line item regarding the expenses, and an expensive one. We're talking about $507,000 they're spending, getting that taken care of. I would want to know why an emergency fund wasn't in place and what their plans were in the future to get one in place. Now, this note here says, Mr. Shelton gave a detailed report on the effects of Hurricane Ian. Mr. Shelton stated that since he has been at Beach Cove, Hurricane Ian is the longest recovery he has experienced. We keep scrolling down. I put on here, Great that a member of the HOA board is not afraid to speak out on a matter and work towards accountability. Now, that line that I read to you is from the 2023 meeting minutes. I go on to write, Hurricane Ian took place September 23rd, 2022 through September 30th, 2022. This meeting took place March 4th, 2023. This reveals that Beach Cove Resort has a history of repairing storm damage in no more than 6 months after the storm has occurred. This seems like a pretty proactive board to me. I like that. Now, one of the reasons why this could still be on the board, could still be on the budget and taking so long to get taken care of, could be due to all of the ongoing projects that they have going on here. You can see regular assessments. You can see special assessment. You can see special assessment for construction on the balconies. You can see special assessments for the insurance. You can see, the insurance wouldn't count for a construction project, but it's definitely impacting them financially, which could be slowing down their ability to take care of the repairs for Hurricane Ian. Special assessment for the roof gable project. And so anyways, they've got lots of projects going on, which could be why the Hurricane Ian stuff is taking a little bit longer to get done. That's just speculation. I don't know. Now, this is a huge one, guys. Professional management fees. Assessing the portion of the budget allocated to professional management services provides insights into the association's reliance on external expertise. Investors should evaluate the effectiveness of management practices and their impact on overall financial management. Now, guys, I've gone on in this comment to say that you always want to have your broker send you the meeting minutes. You always want to review the meeting minutes before buying an oceanfront condo at a beach or resort. Now, here's one thing you must find under the finance section of the most recent meeting minutes. A statement like this, and I'm going to explain this in just a minute. It says, on page 22 of the handout, Mr. Wheeler stated that the certified audits have always come back favorable. This is super important because it helps to ensure the financial health, compliance with regulations, and governance practices of the HOA governing the oceanfront condo resort you're about to buy into. This level of transparency helps maintain trust within the community of owners at the oceanfront resort. Basically, you want to make sure that the HOA is being poured into and receiving professional advice by certified public accountants. When you see that they have an audit line expense or professional management fees in their budget, that's going to let you know that they've got somebody that's of a professional manner, a certified public accountant, that's advising them on potential risk and areas of problem that they're noticing in the meeting minutes or on site or in the budgets. They're also going to be helping to give advice most likely on strengthening their current internal controls and their internal processes, which again is huge, guys. And they're going to issue an opinion on the financial statements, the budget that we're looking at right now on the financial statements, guys. And you want that opinion. You want to know what a certified public accountant has got to say about how the HOA is conducting their affairs and how they're preparing these financial statements. And that's going to be in accordance with GAAP, which is called Generally Accepted Accounting Principles. So in my mind, this is extremely important. I want to see this happening at any oceanfront condo that I'm going to invest in. All right, guys, moving right along to the reserves. All right, basically the reserve fund contribution. The reserve fund is crucial for funding future major repairs and replacements within the community. Out-of-state investors should examine the percentage of HOA fees allocated to the reserve fund to ensure adequate savings for long-term maintenance and improvements. Now, a good rule of thumb for reserve funds are a minimum of 10% to as much as 20% of the collected monthly HOA dues. See the following math. This is how I broke it down. One bedroom HOA monthly, charges $727. Two bedroom charges $975. Three bedroom charges $975. Total monthly HOA dues across all unit types come out to $2,677. 10% of that is $267.70. You multiply that by the 334 total units at Beach Cove Resort. That brings you to a whopping total of $89,411.80. This is 10% of the monthly HOA dues on average across all unit types. Now, they currently have in place $140,000, so they have more than 10% in their reserve fund. Now, if we take it at 20%, that gives us $535 per unit. If you multiply that by 334 units, you've got $178,000. Now, they don't have 20% yet. They have $140,000. They've got more than 10%, but they have less than 20%. They are aiming to increase it to that $160,000 next year. So that's a good sign they're moving in the right direction. Beach Cove Resort has $140,000 in reserves for 2023. They have projected $307,789 for 2023 and is now approved at $160,000 in reserves for 2024. They are a little higher than 10% of the collected monthly HOA dues, but lower than 20% of the collected monthly HOA dues, and currently moving in the right direction by increasing their reserves. You must also keep in mind if they had to use some of their reserves in the previous year to fully cover or offset previous project costs. Now that's important. Then they could be having to rebuild their reserve fund currently. Now your broker would have to contact the property manager to find out if that is the case, or if you could get multiple years meeting minutes, maybe the 2022 and the 2021, along with those budgets. You could look through those historical budgets and review them like we mentioned at the start of this video to see if possibly they dipped into their reserve fund to cover any expenses, and now they are currently rebuilding. Now, prior year's variance. Prior year's variance doesn't suggest any trend or pattern the prior year's variance doesn't suggest any trend or pattern of under or overspending. And it looks like they didn't have any unexpected cost, which could signal that the HOA board has a great handle on their operations and are adequately, effectively managing operations. So basically, guys, they are coming in their variance is spot on. They have basically no variance at all, which means they're not underspending, they're not overspending, and it looks like they didn't have any unexpected costs come up. So they might have a great mindset in understanding how to adequately assess circumstances and make sure that they're doing things correctly. Now, variance in general, budget variance. Monitoring the budget variance helps identify discrepancies between budgeted and actual expenses. This metric provides valuable insights into spending patterns and allows investors to address potential overspending or unexpected cost effectively. So basically, that's what we're looking for when we're looking at the variance metric. We're going to see, hey, did they have to spend a whole lot more money? Well, why did they have to spend it? Why weren't they taking that into account when they originally came up with the projected budget? And then, hey, why are they underspending? What happened? Did they have to not, spend money on something that they were planning to spend money on? Okay, well then what happened there? You always want to be checking into that and making sure that the board has a good handle on things. Now, this at the bottom of the budget just shows you some of the assessments that they have going on. As you can see, this is the total, $3.2, and it tells you, this says regular assessments. Those would be covered in some of the previous year's meeting minutes, I would imagine. They obviously have an insurance assessment going on for $1.9 million. That's as of 2024. You can see here, there's 3 different installment payments. They've currently already done one at January 1. They've currently already done another at May 1st, or they're doing another one on May 1st, and then they have another one scheduled for August 1st. The same sort of thing on this other regular assessments. They did one quarterly over 2022. They did one quarterly over 2023, and they have one in place quarterly over 2024. So if you owned a 1-bedroom unit, you could expect to spend $2,179 quarterly. If you owned a 2 to 3 bedroom unit, you could expect to spend $3,079 quarterly. Now, here again, they've broken the insurance assessment down. You can expect to spend $2,544 on a 1-bedroom, as of January 1. Obviously, that one's already paid for. So if you bought a property now, you shouldn't have to pay that. It should already be paid for by the seller. And then as of May 1st, you have another assessment coming up. And then again, if you have a 2 or 3 bedroom, that was $3,594. Again, $3,594 for each of these different installment payments. Now, for the upcoming one in August, they don't have an amount. It says pending based on possible increase in premiums. They don't know just yet, so that's yet to be determined, but it is going to be due August 1st. if in fact they have one. Now, there's a special assessment for elevators. They've obviously replaced all those elevators. I showed that to you guys. If you own a one-bedroom unit, you're paying, $3,576 for that. If you own a 2 or 3 bedroom unit, you're paying $5,053 for that, for a total of $1.35 million. There was also a special assessment for roof repairs. Let's read this note real quick. This is what's called a capital improvement project. That was $1.5 million. If you own a 1 bedroom, you're paying $3,974. If you own a 2 or 3 bedroom, you're paying $5,614. And that pretty much is a quick, 8 tips for reviewing, 8 metrics for reviewing HOA budgets in the Myrtle Beach market. Guys, you gotta trust me. You made it to the end of the video, but you need to click the video that's on your screen right now to hear how Matt Freeze makes $15,000 to $30,000 a year in annual profit off each of his 8 Myrtle Beach oceanfront condos. That's over $180,000 in average annual profits right there in passive income each and every year. Click the screen now.